This is the Dough Roller Money Podcast. I'm your host, Rob Berger, and I'm doing this live as I've done in the past. And hopefully things work out well. The last time we had a bit of an issue, if I'm, being honest, but I think I've got things figured out. We'll see. And so this is not part of the Rob Berger Show, but rather the Dough Roller YouTube channel because I'm in a T-shirt. I don't know. That's just what I've done. This is the Dough Roller YouTube channel gets a T-shirt. The Rob Berger YouTube channel gets a fancy button-up Untuck It shirt. So there you go. So if things are working well today, what we're going to talk about, three things as always. We're going to talk about the importance of tracking your net worth and some tools to do it. We're going to look at sort of a real-life situation that's unfolding now that to me it explains why we should have more than one bank account. And then we're going to talk a little bit about the yields. There's been some pretty significant movement in Treasury yields. And I want to talk about it a little bit today. So that's what we're going to do. So let's dive right in, and we'll start with net worth. So I'm going to show you a couple of tools, but the thing about net worth, we think about, you have a budget, monthly budget, maybe you do a budget annually, and maybe you track your net worth. They're obviously related, but very different things. When you think about a budget, it's over a period of time. So maybe you have your monthly budget, or maybe you do an annual budget, but it's over a period of time. Not unlike a corporation's income statement. When you look at Apple's or Amazon's, they just released earnings. They have an income statement of operations, but an income statement, and it's always for the 12 months ending, or the 3 months ending. It's over a period of time. Over this period of time, this is what happened with our finances. A net worth statement or balance sheet is for as of a set time. The thing that's unique about a net worth statement or balance sheet is that it reflects everything that's happened from the beginning of time for that individual or family or company up until the present. So if you came up with your net worth statement today, it would reflect every decision you have ever made as it relates to money. So if you go back, I think back when I was a kid, I had a paper route. I don't recall actually saving any of that money. But had I saved it, it would be reflected in my net worth statement today. Because I didn't save it, it's not there. So you can think of the net worth as really your ultimate scorecard. When you want to track how you're doing, there are other things to look at that are important. Getting out of debt, maybe improving your credit score. Certainly your budget is very important and you want to spend less than you make. But the ultimate scorecard is the net worth. And so I think it's important to track it. Now, one simple way is just with a spreadsheet. And I do track our net worth on an annual basis in a simple spreadsheet. And it's not complicated or fancy. I've got, just assets and then liabilities. For assets, I don't include like personal possessions or even cars. I just include, I do include our house and then our investments and that sort of thing. So it's very easy to put together. Each year it takes me maybe 20 minutes to update it. I update it the first of the year. Now, there are some other tools, though, that I also use, and I'm going to show you two of them. And that's not one of them. Here's the first one. So this is Empower. It used to be called Personal Capital. This is a demo account. And you connect all your bank accounts. You can connect your credit cards, all your investment accounts, your retirement accounts. It'll update everything automatically. You can go to Overview and then Net Worth, and it just keeps a track of your net worth, and it keeps track of it over time. Now, in this case, in this demo account, I just have a couple of accounts that I sort of made up for this demo account. But of course, if you had a mortgage, you could track that. That would show here student loans, credit cards, as well as other assets. You can even link your home value with Zillow down here. So it tracks crypto. I don't own any crypto, but if you did, you could track that. So the benefit of this tool is it's free. It's very easy to use. And I think it's got a great user interface. I will tell you that Empower, you say, well, boy, that's awfully nice of Empower to make this tool. And it includes a lot of other things. You can evaluate your investment, your asset allocation. You can do retirement planning. You say, well, that's awfully nice of Empower to give us this tool for free. Well, it's a marketing tool for them. They're looking for, they manage money. They're an investment advisor. And so they're using this sort of a marketing tool. And so they will reach out to you and offer to evaluate your portfolio. It doesn't cost you anything, but you can do it or you don't have to do it. But you should know, nothing's truly free in life. And so that's the deal behind Empower. They give this free tool away, but it helps them attract clients. if that it doesn't appeal to you. Now, it's never bothered me, and I know it doesn't bother a lot of other people, but some people email me and say, yeah, I don't really like that. Another alternative is Cubera. And this is actually a fun tool to use. I will tell you, it doesn't have the features that Empower does. It's not going to, not going to dig into your asset allocation and show you all of this. It doesn't have a retirement planning tool that you can use to test out retirement scenarios. It's, for the most part, tracking your net worth. Now, you can connect your accounts and, just about any kind of account you want, including your debts. I will say it has a super, super clean interface. So I really do like the sort of the look and feel of this tool. And they have other things like what they call, you can see it here, it's kind of small, but safe deposit box where you can store confidential data, documents and whatnot. Although frankly, and this has nothing to do with Cubera, but I'm generally reluctant to upload confidential documents to, just about anywhere for that matter. But you can do that. And again, the interface is excellent. It'll show you your net worth over time. It'll project your net worth into the future if you want to kind of get a guesstimate of what it might look like, 10 years from now. So I really like this tool. So you can check that out. I'll leave links to all of this below the video. The real takeaway is I think it's super important to track your net worth and to do it over time. If you just do it with a simple spreadsheet, I have just a column for each year. I guess 2 columns for each year for the account and then the value. I break it down between retirement and non-retirement. And then in retirement, I break it down between Roth and traditional, and I guess HSA. But I use these tools as well. So I kind of do it a couple of different ways. But I think the real key takeaway is that you want to, however you do it, tracking your net worth really is the ultimate scorecard that will show you your progress as you move forward in life. So that's the first thing I want to talk about today. Pretty straightforward, but I like those tools. Wanted to show them to you. Now let's get to multiple bank accounts. I've always had multiple bank accounts. At some point, it was like a checking account at a big bank, which is pretty much what I've done, since getting out of college 30 years ago. Has it been that long? Anyway, and then at least one online savings account, if not more. And I came across this article today I want to show you. And I don't know exactly what's going on, but this was on CNN. Apparently, some folks that bank at Wells Fargo woke up this morning and didn't have any money in their account. I laugh, I guess, because it didn't happen to me. That's actually not a lot of fun, is it? And I guess they got on to Twitter and were claiming they couldn't access their money. And so it was this big issue. One person, according to CNN, tweeted that he had been hit with an overdraft fee after money went missing from his account. Now, I suspect that, Wells Fargo, it's a technical glitch. They're going to figure this out. Maybe it's even resolved by now. This was published, I think, earlier this morning. Well, not that long ago, a couple of hours, updated 11:48 Eastern time, so about 2 hours ago. But if you find yourself needing some money right now and your only account is at Wells Fargo, that's kind of a problem. And so I think it underscores the importance of having at least 2 accounts. So I can tell you what I've done. As I mentioned, I've always used sort of a big bank for our checking account. I just like the convenience of branches and all that. On Dough Roller, again, I'll leave a link to this. We've got a list of 10 of the best free checking accounts, and we kind of have a mix. I think if I were opening an account today, I'd probably strongly consider this Chase Total Checking right here. It comes with a $200 bonus if you meet the requirements. But we have Discover in here, Fifth Third, TD, Capital One, and my kids. We had the Money Teen checking account for them, way back in the day, and that was actually excellent for a teen checking account. Highly recommend that. We have some other sort of fintech, like Wealthfront gives you 4.8%. Betterment checking is for the first year 5.25% right now. So a lot of, I guess, depending on what your goals are, you could go with a big bank, you could go with a fintech like Wealthfront or Betterment. Or Chime, if you wanted to. But I think you want a checking account, obviously. My preference has been a big bank, but you may want something else. Good options here. And then get a savings account at a different bank. And normally, not necessarily with these fintechs, because with these rates, you can just keep all your money in the checking account, assuming there's no caps on those rates. You want to always check that. But like if you're a Chase, their savings accounts are probably not going to be the best in terms of APY. I'm looking at our site. We're tracking the best savings accounts around 525 right now. So, in many cases, particularly if you're at a big bank, it kind of makes sense to have your savings account at a different bank anyway. So, but I think the big takeaway is I saw that Wells Fargo article and I thought, it really is important to have a couple of sources of cash. Now, it may be a big bank checking account or fintech, and then a brokerage account where you have some cash, maybe in a cash management account that you can get access to quickly. Yeah, that'd be fine too. I just always like to have at least two sources of cash, at least two ways to get at money if I really need it. Okay, so the third thing, there's been a lot going on in the bond market, in the yields. And I want to show you that and talk about it for just a little bit here. So here are the yields. Now, this is just for the month of August. You can see it's by date. And these are Treasury. So that would be a T-bill, 1 month, all the way up to 1 year is here. And then we go all the way out to the long bond, 30 years. There's a couple of very interesting things happening. First of all, and this has been happening for a while, but the higher rates are actually the shorter term. What they call it an inverted yield curve, where at least it's inverted to a point, right? And sometimes they compare the 2-year and the 10-year, 4.9, 4.2. Normally, in a normal yield curve, the further out you go, the higher the rate, because it's more risk. You're locking your money away, say for 10 years or 30 years, and you're going to expose it to whatever inflation happens to be over that decade or 3 decades. And so investors typically, say, hey, I want a pretty good yield to take that risk. But we know that sometimes the yield curve inverts, where the higher rates are actually on the shorter end of the yield curve. And sometimes that predicts a recession. But that's the first observation. If we're looking for the better yields right now, they're still on the shorter end of the yield curve. That's the first thing. But the second thing is look at this 30-year. It was 4.11 just 2 days ago or 3 days ago, the first. And it jumped 21 basis points in 2 days. Now, that may not seem like a lot, but in the bond market, that is huge. That is a massive jump in just 2 days. And I wonder if we go back, let's see here. If we go back, how far back can we go? I want to go to the end of July. I mean, if you look at this, look at this. July 12th, it was 396, 396. And from there, it's gone up. So it's gone up almost 40 basis points from just a couple of weeks ago. So it's really gone up significantly. And there's a lot of folks, if you follow all of the news on yields, which I do, you get a lot of people out there trying to explain this. And I'm not sure, I take some of those explanations with a grain of salt. Some are thinking, about the longer term impacts related to inflation. But here's the point that I want to make it. It's not to try to predict what yields are going to do in the future. I just think that's difficult, if not impossible. But it's this. If you're saving for something short term, you're going to go on a vacation in 6 months, or you're going to buy a car in a year, or you're going to buy a house in a year. T-bills are, they're great rates that you don't pay state and local income tax, a great option. Short term, you need the money in 6 months, get a 6-month T-bill. You need it in a year, get a 1-year T-bill. I think that is a very reasonable approach. What I've seen a lot of people start to do, though, is to put their long-term money, like think for retirement, more and more and more into T-bills. And I get it. Look at these yields. In fact, we can compare those yields to, let's go over to Morningstar and compare it to a total bond fund like B&D, which is a Vanguard total bond. It's an intermediate term government and investment grade corporate sort of total market bond fund. And here it is. And their current yield is 4.5. So you think about this and you think, well, wait a minute. Why would I keep my money in this intermediate term bond fund that's only paying 4.5%, and more of it's subject to state and local income tax, because a lot of this is corporate bonds, when I could put my money in treasuries, shorter duration, get over 5, maybe 5.5% yield, and not pay state and local income tax? Well, yeah, that's great now. Here's the issue. If these yields start to come down, that means prices are going to go up. So what you could find yourself in, if you're not careful, is in the shorter end of the yield curve when the rates go down. And if you think then, oh, wait a minute, the yield curve is normalized. Let me then move my money back into, whoops, not my podcast. Here we go. Back into a BND. You could find this fund to be a lot more expensive with the yields a lot lower. You could be buying in at a higher price, is the long and short of it. And so it's one of the reasons why I don't really do that with my bond portfolio. I've left all of our sort of long-term asset allocation, retirement funds in a BND or similar type intermediate term bond fund, in some cases TIPS as well. I do have some T-bills, but it's for either the emergency fund or money that we're going to spend in the next year, because we have some things that we need to spend some money on. And so I know we need it. So of course, T-bills make perfect sense. But I want to caution against chasing the yield, because I think it can get a lot of folks into trouble and perhaps cost you more money than you might think. So at least consider that. I know those yields on those shorter duration, T-bill type investments are very attractive, but you got to be careful. I think you could end up losing money in the long term if you chase those yields. That's just my 2 cents. So there you go. I kind of went through this pretty quickly, but those were my 3 topics today. Net worth, very important. Track it however you do it. I use a multiple of tools, but put it on a piece of paper if that's how you roll. But it's important to track it. And I even show my wife once a year, and she's like, yeah, okay, whatever. I highly recommend at least two sources of cash. It could be a bank account and a brokerage account where you've got cash. It could be 2 bank accounts, whatever. You don't want to get stuck not being able to get your money out. And then that's what's going on in the yield curve. I think it's interesting, great for short-term cash. I mean, I love putting the money we're going to spend in the next year into T-bills and getting that kind of return without state and local income tax. But for long-term investments, you got to be careful. It's not quite as simple as that. And it could end up getting burned, depending, of course, on what yields do. And if you've got a prediction, good luck. I certainly don't. Every time I predict yields or interest rates, I find out I'm absolutely, totally wrong, not even close. So I don't even try anymore. At least that's my approach. Well, there you go. If you have any questions, leave them in the comments below. I will, as soon as I end this live stream, put a bunch of links below the video so you can check that out. And there you go. Hope you have a great weekend. By the way, I don't think I actually said what episode this is. Believe it or not, this is episode, I think, 366. We have over a year's worth of podcasts now. There you go. Well, until next time, remember, the best thing money can buy is financial freedom.